Morning, market chameleons, and soon to appear the king chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning. Well, sorry, I had the mute on. Couldn't click it off.
No worries. No worries. Everything good?
Good morning. Yeah, how are you doing?
Great, great. Let's get right to the disclaimer and then to the pre-market, see what's going on.
Okay. So good morning, everyone. Thank you for joining. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not giving you advice. We're telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help provide you with guidance and answer your questions. There's the disclaimer.
Excellent. What are you seeing this morning in the pre-market? Anything interesting?
Let's take a look. So what we'll do today, I think, is we'll take a look, anything moving in pre-market hours. If there are questions, while we're doing that, I'm going to try to answer those questions, or as many as I can before I go. If there are no questions, I might just turn and take a look at either bullish, bearish ideas.
Sounds great.
Around it. So right now we're looking at the pre-market report, and these are stocks trading in the pre-market hours. Got the most active stocks, biggest percentage gainers, biggest percentage decliners. Let's take a look what's going on in the higher market cap stocks. So I'm going to use this filter to look for stocks with a market cap of 20 billion or higher. Filtered that out, so we see 9 made the percentage gainers list, 13 on the percentage decliners list. A couple of them, I think, had some earnings. Well, the one that had earnings, I think Carnival yesterday. So we see that's up 2%. In the pre-market hours, VIC just jumped up 2.5%. Looks like there might be some headline news there, but I can't interpret it just from the headline topic. But that's up 2.5% on almost 1 million shares. Nothing else right now is sticking out at me, so I'm going to go to the unfiltered list. And on the unfiltered list, these top one is SOS, up 31%. That's trading 23.8 million shares in the pre-market hours. It's an $800 million market cap stock. Also looks like that's moving on some news. Again, some of these are lower market cap stocks that are up in the pre-market hours. UTME up 25%, CBAT up 17%. To save time for, on some of these bullish bearish ideas, if there are no questions on the pre-market stocks, then I'm going to move on. So let me know, Will.
Yep, you can move on.
Okay. So let's take a look. I'm going to go right now to the home page over here, and you could see here the home page here. You have a bunch of tabs here, at stocks that are most active options. We got bullish opportunities, bearish opportunities, custom, and bullish opportunities that are based on seasonality trends. So let's take a look at the bullish opportunities, and we get a list of stocks here on the left-hand side. So we got, top right now, I think they're sorted by market cap up here, but you could click on any of these and sort by, percentage change, alphabetically, price of the stock. Let's just stick with the market cap. So we got Visa, MasterCard, top of the list because of their market cap, Bank of America, Procter Gamble. So I think I'll maybe focus on the Procter Gamble. Of course, there was some interesting news. I think Visa is going to get into the Bitcoin market, digital currencies or processing based on that. Some of the technologies around the blockchain using the Ethereum. So that was announced, I think, maybe a week ago or so. I think MasterCard as well. So that'll be pretty interesting to see how that develops, over time.
But I also read today they're forming a lobbying group, Fidelity, Square.
Yep.
Yeah, some interesting stuff
So,
going on in that space.
so that space, the DeFi space, the decentralized financing, a lot of interest right now there, from the perspective of development, investors, definitely the community around these cryptocurrencies. Very excited about the prospects of decentralized financial apps. And you see even like some big names now, like, Square getting into
PayPal.
funds, huh?
PayPal.
PayPal. Yeah. So we'll see how that develops. And I think that there's supposed to be, if anybody follows these cryptocurrencies tokens, I think Ethereum is supposed to push out some new technologies that are going to make it more scalable, faster processing, and you're able to attach value to tokens, and you're able to, like, just like the NFTs. I think that's on the Ethereum platform. So a lot of interesting things going on there. And again, Visa, I think, chose to do it on the Ethereum platform, I believe. So, but let's focus, maybe let's just take one today and kind of walk through a bullish idea. So let's see Procter & Gamble here. And this list here, it's generated looking at, just from a technical perspective, if a stock is currently in a uptrend or created a bullish crossover, and it's just looking at the basic moving averages. So that's the first filter. Once it filters those out, then it looks for option strategies with a theoretical edge. Okay, so those are your first, starting points, and then once you could take a look at that and analyze it further. So these are just starting points, but the two main filters here: stocks either on a bullish uptrend, made a bullish crossover, and we detected a option strategy with a theoretical edge, to a bullish option strategy with a theoretical edge. So let's see Procter & Gamble here. It generated two trade cards. These are based on yesterday's closing prices. So the stocks aren't open yet today. So this is yesterday's closing prices. A bull call spread. So this is the first strategy. Oops, hold on. I clicked on the report by accident. Bull call spread. It's looking at the April 9th expiration and buying the 135 call, selling the 139 call, April 9th expiration. So that's expiring this week. It would cost $1.74 based on yesterday's closing prices. We think theoretically it's worth $2.01. That's a 15.4% theoretical edge and a historical probability of success 60%. It also generated a bull put spread. So this is looking April 16th. So here we see Procter & Gamble earnings are expected April 20th. So both of these expire prior to earnings. This one's looking at April 16th expiration, selling the 136 put, buying the 134 put. So that's a $2 put spread, 136, 134. That's for a credit of 57 cents. So remember, when you're selling a higher strike put, buying a lower strike put, you're getting a credit, 57 cents. We think it's worth 40 cents based on historical stock behavior. So if you're selling it above the theoretical value of 40 cents, 57 cents, that's a 17 cents edge. That's a 12.2% theoretical edge with a historical probability of success 77%. So let's analyze this put spread here. Okay, I'm going to click on this over here, take me to the options chain. Right, so when I click this, it's going to go to the options chain and populate these legs so we can analyze it further. So click in here, options chain. And now we're going to be on the Procter & Gamble options chain. It's going to go automatically April 16th expiration here. This is the options chain with the calls on this side, puts on this side with all the prices. and this is what it populated here. Buying the April 16th 134 put, 62 cents. So let's find that on the options chain. 134 put right here, it's 56 cents, 62 cents. So buying this for 62 cents, selling the April 136 put for $1.19. So here's the April 36 put, the $1.19, right? If we do that, spread, load strategy, this is what it looks like at expiration, the payout diagram. So here we see that if we do that spread, selling it for $1.19, buying it for 62 cents, we get a 57-cent credit, right? The midpoint is 67 cents, so I just kind of always want to point that out. When you're doing these trades, you always kind of want to look at the market, the bid and the offer, and where the midpoint is, and try to get as close as you can to that midpoint, because that midpoint would be considered the mark-to-market fair value. The further you get away from that midpoint, the higher the fee you're paying to get your execution. So here you see that's 10 cents, right, away. So that's still pretty decent distance away. When you're doing these, keep, kind of make sure you're looking at that, how wide the markets are, and stay as close, the better. If you could get midpoint, that's great. If you could do better, if you could sell it above midpoint, that's even better. But you don't want to go too far away unless you're very confident about that trade, because that's kind of your fee to execute the trade. So here, this assumes that you're executing it right on the bid. You seek the immediate execution, got it at 57 cents. If that's the case, this is what your payout diagram looks like. That if the stock closes here, exactly the same spot at expiration, right? So this is expiring April 16th. It closes right at the same spot here. Well, both of these puts will expire worthless. So the stock will expire right now. It's at 136.47. So if it's 136.47, the 136 put is out of the money, 134 puts out of the money, both these expire worthless. You get to keep that credit that you sold it for, and you can see either that's your profit. If the stock goes higher, obviously that's still good for you, because these puts will be out of the money. They expire worthless. You keep the 57 cents. You have a little bit cushion to the downside, right? Because if the stock's 136.47, as long as it stays above 136, you can keep the same, you keep that credit. If it falls below, that's where you start losing. And if it really crashes, then your max loss over here, once it's below 134 at expiration, 134 or lower, you have to buy that put spread back for $2. So if you buy it back for $2, you sold it for 57, you lose $1.43. So that's your loss. Now, any price you get above this shifts the entire curve up. So if you sell it for 67 cents, then your profits are higher, it goes from 57 to 67, and your potential losses will be less. So those will decrease by 10 cents to 133, right? So the higher you sell it, this whole thing shifts higher. So let's take a look at, I'm going to come up here. And
yeah. Jake was asking a question. Unfortunately, it runs at a delay. He's asking the red and green columns on the implied values for the options chain. What exactly do they mean?
The red and green, the Theos?
I'm assuming yes.
Okay. So over here, so we have over here the how did he say the implied? What was the question again?
Jake says, ask D what the red and green columns mean on implied values for the options chain.
Maybe he means like the theoretical values. So when we look at the options chain over here, right? Typically, what we're going to get from the exchanges, the open feed, are the prices, right? So we have to figure out what is the bid and the offer, you know, in the call, in a certain expiration in the call, and in the put. So then once we get the bids and offers as reference prices, we want to see, well, what do we think theoretically these options can be worth, right? Because all you're looking at is a price. So how high is the price? How low is the price? Is it a good deal? Is it unreasonable? So as mostly professionals, you know, you generate theoretical values to give you those references to quickly assess, you know, how far away is it from a certain benchmark, right? So if you think of if you're buying or selling real estate, right, you would, and you had a house somewhere in Pennsylvania to buy, and exactly the same house in San Francisco, but you have two different prices. So so the one that's in Pennsylvania, just because it's lower doesn't mean it's a better deal. You kind of have to generate, well, what is the fair value of that house, and what's the fair value of one in San Francisco, because those are typically higher. So you would take the one in San Francisco, and just to make it really quickly, if it's for sale for $1 million, right? But on average in that neighborhood, if you calculate, well, the average sales, similar houses, 1.2 million, well, that could be, that 1 million could potentially be a discount, right? Because if on average that's what they sell for is 1.2 million, you know, that could be a good deal. And the one in Pennsylvania that's for sale, let's say for, you know, 200,000, but on average those houses sell for 180,000. Well, that could be too high. Okay, so we create, when the theoretical values in between, you know, the markets are quick reference points to try to create a theoretical value or benchmark to see how far away these prices could be from a certain benchmark. And you could change it by using different models. So right now, the default is going to a best fit model, which basically looks at the implied volatilities of the different options, okay, on the board, and creates a regression line, a smooth line to see, to create theoretical values along a through the implieds. You could change that by saying, well, what if I run a Black-Scholes, or in our case, binomial model, and I give it a different implied volatility? So the option pricing models, right, if you put in certain inputs, the output is what the theoretical option price should be. And the biggest input is the implied volatility, right? What you think the volatility of the stock will be going forward. So you could do a custom one, and you could just say, well, I think the implied volatility going forward will be 20, right? So if I run a 20 volatility, press OK, all these implied values will run a 20 volatility, and they'll give you a theoretical value. So this way, if you feel like 20 volatility is a good benchmark, then you could compare it and just say, well, these look relatively cheap, right? Or you could say, I think that whatever the stock moved at the last 20 days, it's going to persist in the next going forward. So the average 20-day historical vol, I'm going to just check on that, press OK, and then it'll give you a theoretical value if the stock moves at the 20-day historical volatility. You could do the 252-day volatility, or the average between them. So this is a 1-year volatility. Press OK. The option pricing, you put that in there, and the option pricing model, that's what says each of these options would be worth, assuming those implied volatility assumptions. Is that kind of answering the question for Jake? Hopefully I'm on the right.
Yeah, no, that's exactly, he said you're in exactly the right place. He does ask, so should I just buy the red and sell the green?
Well, remember, you're using a theoretical value to give you an idea how far away it is from a benchmark, right? So there's no such thing as this is definitely, if it's a red, I should definitely sell it, or green, it's kind of, you're still have to make an assumption where you're like, I believe, yeah, that the options, that the volatility of Procter and Gamble is going to be low in the next 8 trading days, right? And that these options are overpriced. You're still making those assumptions. So, it's no guarantees. You're just looking at a theoretical model to give you a sense of how far away it is, or how much edge, how much extra cushion do you have. So if you feel volatility will be low, stock's not going to move around, and you're like, well, if I use this model, I have like an extra penny or 2 penny cushion. But we don't know what's going to happen in the next 8 days. Does that make sense? Hopefully.
I think it does.
Right. Okay. So yeah. So you use it kind of as like a guidance, while you're making your decisions. Now, and down here, I'm running different theoretical models. So there's no one theoretical model that is right. Okay, these are all theoretical models. They're all, nothing necessary is right. It's just giving you a benchmark. So like, when you think throughout the financial industry, even like hospitals, right? Hospitals use theoretical models to determine how much of a vaccine they need, how many bandages they need, how much, so they're using these data and models to anticipate, their supply chains. There's, doesn't mean there's one right or there's an exact. They're estimating and changing based on reality. They're changing their inputs in the models. So more people are getting sick, they might need to order more. If less people, they might need to order less. Same thing with most businesses when they're trying to anticipate. A restaurant needs to anticipate how much food they need to buy, right? Inventory, all these they're using models to estimate, okay? But there's no like exact to say, because some people want exact. There's no such thing. It's all estimates because these are unknowns. I'm going to use a different theoretical model here, down here, to see what do we think this spread might be worth. Okay, so what do we think this spread might be worth using historical return distributions? So instead of just plugging it into the Black-Scholes model, I'm going to start using different assumptions, and I'm going to start accounting for the implied volatility. So I'm going to look at historically, how did the stock behave over an 8-day trading period? Okay, so there's 8 trading days to go. How did historically, over an 8-day trading period, how did the stock behave in the last 4 years? I'm also going to adjust it for dynamically looking for implied volatility ranges. So it's going to look back in history and look where the implied volatility was similar to what it is now. And it's also going to take out, we see that there's no earnings. We're not anticipating an earnings event between now and April 16th. It's going to go in history and look at historical behavior, but excluding when there was an earnings event, because the earnings stock moves differently. So it's taking all these other things into consideration. And these models are algorithms, right? So it's not just inputs, they're algorithms looking through situations, trying to, create like a similar situation. It goes back, then reruns it and says, okay, after an 8-day period, if we did a similar spread with same days to expiration, same distance of the strikes away from the spot price at the end of the term at expiration, on average, what is this spread would be worth? And on average, in the last 4 years, it says it would be worth 44 cents. Okay, that's the historical average end. So if In other words, if you did the same spread over and over again, got 53 observations in the last 4 years with some similar circumstances, the average price at the end was 44 cents. What if you, historically, if you sold it at 57 cents, this is saying 73.6% of the time, you would have been able to buy back for cheaper than 57 cents, resulting in a profit. Okay, so sometimes it would have been higher, you would have been losing, sometimes lower. This is the average end value. This is the frequency of times that it was profitable. Now we could change those assumptions. You could do different number of years. I'm going to reload it. So in the last 2 years, on average, it's worth 53 cents, right? If we just use 1 year's of data, average end value 55 cents with a 70% historical win rate. What if we changed the assumption and said, show me all the implied, I don't care where the implied vol was at the time, I want to see all the results. You could change that here, reload it, and there you go, 55 cents. Let's see in the last 4 years, 45 cents, 74. So you have the ability to change, these assumptions and rerun it. Okay, let's stick with I think the original one was dynamic, 4 years. So you have 44 cents, 73.6% theoretical win rate. Any questions on this stuff? Well, no. So I'm going to come up here and take a look at the stock statistics as well. How did this stock tend to behave? Statistically, we're going to look at seasonality, stock drift, and right now we've already filtered it out because we know that the stock's in a bullish crossover technically. So it's kind of behaving in a bullish manner. Seasonality, how did this stock historically tend to do between April 6th, which was yesterday's close, and April 16th, which is the expiration? So in the last 10 years, during that period, calendar period, the stock was up 75% of the time. So during that period, 75% of the time it finished higher. On average, it gained 1.3%. So I'm hovering over there to get more statistics on this. So the average of all the up moves during that period was 1.9%. The average of all the down moves was negative 0.7%. So we see there's still a bullish bias. The best return it had during that calendar period in the last 10 years was up 3.9%. The worst, it was 1%. Okay, so that's looking at statistically the calendar period. An 8-day hold period. So we know that there's going to be 8 trading days, 8 days of volatility. How does this stock tend to do over an 8-day period? So here we go. Historically, 55% of the time over an 8-day period, it finishes higher. For an average gain, on average, half a percent. So if we took the average of all the up moves over an 8-day period, that's 2.2%. The average of all the down moves, negative 1.7%. Best 8-day gain, 7.3%. Worst, negative 8.1%. So we see still slightly biased towards the bullish side over an 8-day period. So these are looking at a statistical analysis. We could also take a look at where's the stock right now valued relative to historical multiples. So I'm going to go here really quickly. I only have like a minute left, so I won't get too deep into it. But here we see on the fundamentals fair value. If we used historical multiples as our benchmark, 3-year average P's, price to sales, price to book, operating income, also relative to the market, implied value is $142.80. It's trading at $136.50. So based on the historical multiples, that's a 4.4% discount. If we do a comparative analysis and say, well, if we use forward-looking estimates, basically, how is it going? If we used expected revenue growth and operating margins for Procter Gamble and compared that to the rest of the market in the next 5 years. And if we said that to make it equivalent to where the market is, this equivalent returns, implied value of Procter Gamble is 174.55. It's trading 136.5. That's a 21.8% discount. If I adjusted for risk, volatility, 179, so still 23.8% discount. So these are, look, we looked at it from a bunch of perspectives. We looked at a strategy with theoretical edge. We looked at the stock, how the outlook for next 8 days using statistical price return distributions, seasonality, and 8-day hold periods. We took a look at theoretical edge using, data, 4 years of data, 1 years of data, I think 2 years of data. I looked at it. We also looked at the stock from theoretical value using historical multiples and forward-looking growth rates. So
awesome job. Awesome job.
So there we go. Try to squeeze in as much as I could.
You always do. All right, let's opening bell just went off. Great job, Demon. Thank you as always.
All right, thanks everyone for joining us. Stay safe out there. Have a good trading day. Hope to see you guys tomorrow.
Trade in peace, community. Bye.